Let me ask you something. Have you ever been turned down for a loan or a credit card or maybe even an apartment and had absolutely no idea why? Or maybe you got approved, but the interest rate they gave you was so high it felt like a punishment. Or maybe you've just never really understood what that three-digit number actually means, or why it seems to follow you around like a shadow everywhere you go financially. If any of that sounds familiar, you're in exactly the right place. Welcome to Glen Talks Finance. I'm Glen, and today we are going deep on credit scores. Not the surface level stuff you've probably heard 100 times. We're going to actually understand this thing, where it comes from, how it's calculated, why it matters more than most people realize, and most importantly, exactly what you can do to improve yours starting today. So whether you're at the gym right now, on a walk, cooking dinner, or just lying on the couch, settle in. This one's worth your full attention. Let's start with the big picture, because I think most people underestimate just how much this number affects their life. Your credit score is essentially a financial reputation score. It's a number usually somewhere between 300 and 850. That tells banks, lenders, landlords, and sometimes even employers how reliable you are with money. Think of it like this. Imagine you're lending money to a friend. You'd probably feel a lot more comfortable lending to someone who always pays you back on time versus someone who borrowed $50 from you 2 years ago and still hasn't mentioned it, right? That's exactly what a credit score does. It gives lenders a quick, standardized way to answer the question, can we trust this person to pay us back? Now, here's where it gets interesting, because it's not just about getting a loan or a credit card. Your credit score affects your mortgage rate. And I want you to really sit with that for a second, because the difference between a good credit score and a bad credit score on a home loan could literally be tens of thousands of dollars over the life of that mortgage, not hundreds, tens of thousands. It affects your car insurance premiums in many places. Insurers use credit scores as a predictor of risk. Better score, lower premiums. Worse score, you pay more. Every single month. It affects whether you can rent the apartment you want. Landlords run credit checks. If your score is low, they might reject you outright or ask for a bigger security deposit. And yes, in some industries, employers check credit scores too, particularly in finance, government, and roles that involve handling money or sensitive information. So when people say, "Oh, I don't really care about my credit score," I always want to grab them by the shoulders and say, yes, you do. You just don't realize it yet. This number is quietly affecting your life whether you pay attention to it or not. So you might as well understand it and make it work for you. Okay, so let's talk about the actual number, because I want you to know exactly where you stand. The scale runs from 300 to 850. And here's roughly how to think about those ranges. 300 to 579 is considered poor. If you're in this range, you're going to have a hard time getting approved for most things. And when you do get approved, the interest rates will be painful. This range usually means there have been some serious issues in the past. Missed payments, defaults, possibly a bankruptcy. 580 to 669 is fair. You can get credit, but you're still paying higher rates than you should be. Lenders see you as a risk. You'll get approved for some things, but rejected for others. 670 to 739 is good. This is where most people are, and honestly, it's a decent place to be. You'll get approved for most things. Your rates won't be the best on the market, but they won't be terrible either. 740 to 799 is very good. Now you're starting to get access to the better rates. Lenders compete a little more for your business at this level, and 800 to 850, that's exceptional. That's the top tier. If you're here, lenders are rolling out the red carpet. You get the best rates, the best terms, the most options. You have maximum financial flexibility. Now, one thing I want to address right away, because I get this question a lot, does everyone have the same scoring system? Not exactly. The most common score you'll hear about is the FICO score, but there's also something called Vantage score, and different lenders sometimes use different versions. The ranges I just gave you are broadly consistent across systems, but don't be surprised if you check your score in two different places and get slightly different numbers. That's normal. The important thing is the general range you're in, not the exact number. So, where are you right now? Do you know your score? If you don't, that's okay. And actually, checking your own score doesn't hurt it. A lot of people don't know that. Checking your own credit is called a soft inquiry, and it has zero impact on your score. So go check it. Most banks and credit card apps show it for free these days. All right. Now we get to the really useful part. Because once you understand what actually goes into calculating your score, improving it becomes a lot less mysterious. Your credit score is calculated using 5 factors, and they're not all equal. Some matter a lot more than others, so let's go through them one by one. Factor number 1, payment history. This is the big one. It makes up 35% of your score, more than a third, just this one factor. And it's exactly what it sounds like. Do you pay your bills on time? Every time you make a payment on time, it gets recorded. Every time you miss one, that gets recorded too. And missed payments hurt. A single missed payment can drop your score by 50 to 100 points depending on your situation. And here's the kicker. It stays on your credit report for 7 years. 7 years from one missed payment. Now, I'm not saying that to scare you. I'm saying it because if you're currently missing payments or paying late, this is the single most important thing to fix. Nothing else even comes close in terms of impact. Factor number 2, credit utilization. This one is worth 30% of your score. Credit utilization is the percentage of your available credit that you're currently using. So, if you have a credit card with a $10,000 limit and you've spent $7,000 on it, your utilization on that card is 70%. That's high, and lenders don't like it. As a general rule, you want to keep your utilization below 30%. So on that $10,000 card, try to keep your balance below $3,000. Below 10% is even better if you can manage it. Here's something that trips people up though. You might be thinking, well, I pay my balance off in full every month, so my utilization should be 0, right? Not necessarily, because the balance that gets reported to the credit bureaus is usually your statement balance, not your end-of-month balance. So even if you pay in full, if your balance was high on the day they reported it, that high utilization still shows up. The fix? Either pay down your balance before your statement closing date, or just try to keep your spending well below your credit limit most of the time. Factor number 3, length of credit history. This is 15% of your score. Simply put, the longer you've had credit accounts open, the better. The system rewards experience. An older account tells lenders, this person has been managing credit responsibly for a long time. That's reassuring. This is why closing old credit cards, even ones you never use, can actually hurt your score because it shortens your average account age. So if you've got an old card sitting in a drawer somewhere, as long as it has no annual fee, leave it open. Use it once in a while for a small purchase just to keep it active. Then pay it off. Done. Factor number 4, credit mix. This accounts for about 10% of your score. Lenders like to see that you can handle different types of credit, not just credit cards, but maybe a car loan, a mortgage, a student loan, a personal loan. Having a mix signals that you're an experienced borrower who can manage different kinds of financial obligations. Now, I want to be clear here. You should absolutely not go out and take on debt you don't need just to improve your credit mix. The impact is only 10%. It's not worth it. This factor tends to improve naturally over time as your financial life develops. And factor number 5, new credit inquiries. Also 10%. Every time you apply for new credit, whether it's a credit card, a car loan, a mortgage, the lender does what's called a hard inquiry on your credit report, and each hard inquiry dings your score slightly, usually somewhere between 5 and 10 points. That might not sound like much, but if you apply for 5 new credit cards in 2 months, that's 25 to 50 points potentially gone. And you also look desperate, like you're scrambling for credit, which is exactly the signal you don't want to send. The lesson here is simple. Be selective about when you apply for new credit. Space out your applications and don't apply for things you don't actually need just because someone offers you a discount at the checkout. Okay, so now you know what the score is, what the numbers mean, and what goes into calculating it. Let's talk about what you actually do with that information. Here are 5 concrete actions you can take in order of impact. Action 1. Automate every single payment. Set up auto pay for every bill you have. Credit cards, car loan, utilities, phone, all of it. The minimum payment at the very least, but ideally, the full balance. Payment history is 35% of your score. It is the most important factor by far, and it is also the most easily fixed by just removing human error from the equation entirely. You don't forget to pay your Netflix subscription every month because it's automatic. Do the same for everything else. Action 2. Aggressively pay down your credit card balances. If your utilization is high, this is your fastest path to a meaningful score improvement. Getting from 80% utilization down to below 30% can bump your score by 50 to 100 points in a relatively short period of time. That's a significant jump. If you've got multiple cards with balances, there are 2 schools of thought on how to tackle them. The avalanche method, where you pay off the highest interest rate card first, or the snowball method, where you pay off the smallest balance first to build momentum. Mathematically, the avalanche method saves you more money. Psychologically, the snowball method keeps more people on track. Pick whichever one you'll actually stick to. Action 3. Don't close old accounts. I mentioned this earlier, but it's worth repeating. If you have credit cards you don't really use, especially older ones, keep them open. Use them occasionally for small purchases. Pay them off. That's it. Closing them shortens your credit history and reduces your total available credit, both of which hurt your score. Action 4. Check your credit report for errors. And this one genuinely surprises people. Errors on credit reports are more common than you'd think. Wrong account information, payments marked late that weren't, accounts that don't even belong to you, fraudulent activity you didn't know about. In most countries, you're entitled to a free copy of your credit report at least once a year. Go get it, read through it. If you find something that looks wrong, dispute it. The process can be a bit annoying, But successfully removing a negative item that shouldn't be there can meaningfully improve your score. And action 5, be patient and consistent. I know that's not the most exciting advice, but it's the most honest. Building excellent credit is not a 6-week project. It's a long game. If you've had some issues in the past, missed payments, high debt, maybe even a default, those things take time to fade. Most negative items stay on your credit report for 7 years, but their impact diminishes over time as you build a more recent track record of responsible behavior. The good news is, if you start doing the right things today, you will see your score move. Maybe not as fast as you'd like, but it will move. And every point is worth money. Every point means better rates, better terms, more options, more financial freedom. So start now. Even if you just do one thing today, set up autopay for your credit card. That's enough to start. All right, let's bring it all together. Your credit score is a number between 300 and 850. It affects your loans, your mortgage rate, your insurance, your rental applications, and more than most people realize. It's calculated using 5 factors: payment history at 35%, credit utilization at 30%, length of credit history at 15%, credit mix at 10%, and new inquiries at 10%. To improve it, automate your payments, pay down your balances, keep old accounts open, check your report for errors, and be patient. That's it. No secret tricks, no hacks. Just consistent, boring, responsible financial behavior over time. And if that sounds unsexy, good. Because the people quietly doing these boring things are the ones who end up with the most financial options later in life. Thanks for spending this time with me today. I hope this one was genuinely useful. If it was, please subscribe to Glen Talks Finance. I put out a new episode every week covering the money stuff school never taught us: budgeting, investing, taxes, savings, all of it, explained simply. And if you've got a topic you'd love me to cover, drop it in the comments. I read every single one. Until next time, take care of yourself and take care of your money. See you next week.